The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, this is Chris, and welcome to our monthly Connect series for premium members. Happy May Day. Today's May the 1st, 2018. It's amazing how it just seemed like it was the 1st of April. We got tax time behind us, and I hope everyone is getting prepared for summer because it's going to be here pretty quick. So as a reminder, our attempt is to share the power of the pattern, share a charting analysis with you that you can see what we think are some probabilities, and to be able to make a decision in your comfort zone in 30 seconds or less. We want to be able to make it quick, to be able to look at charts. And again, it doesn't matter if a report's 25 pages long with 25 reports, or 25 charts, excuse me. Our intent is that you can look at each idea and see really quickly if you'd like to participate or not. And as a constant reminder is we're not bullish or bearish. We're just bullish on opportunities. And we always believe that they're out there. And I still am extremely encouraged in the world that we live in. I think the opportunities, this is my 38th year, are as great as they've ever been. As a reminder, we started a couple of webinars ago to give away some Amazon gift cards, and we've given away a few $100s worth to this point. And today we're going to give away a few more. And so it's a reminder in the upper right of the screen. If your webinar piece is kind of hidden or shrank to the right side, you can hit the orange arrow and expand it. And what we'll do is when we ask a question, you can answer it by clicking on the question box and typing your answer in. And just a couple of reminders, we're not going to try to notify the winner during the webinar. Rick will be monitoring all of the different inputs. It's been fun. A lot of you have been very accurate and very quick. And then a second reminder is we'll just have, if you win, you can only win one time per webinar, just so that we can spread the loot around, spread the Amazon gift cards around to everybody. So let's go ahead and get started. And I continue to believe that I don't know exactly why, everyone, but I believe the main influence to the market has been the Fibonacci 261 extension level. As a reminder, we looked at the Fibonacci, the two most emotional highs and lows, and in my opinion, over the last 11 years, were the 2007 high indicated by this arrow and the 2009 low. These were monthly closing highs and lows in 07 and 09, applied the Fibonacci to them. And so what the Fibonacci 261 extension is, we welcome all the new members. We appreciate the new business. What the 261 extension level is, it's taking the distance in the darker blue shaded area, and it's 261% movement out of there, and that's a Fibonacci ratio, obviously. For whatever reason, this is always beyond me. It's fascinating and fun. We've been watching this level, been sharing it with members for I think 18 months. It ran into the Fibonacci 261. This is the S&P back in January. And you can see since then it's created a series of lower highs. And so this continues to be, in my opinion, the main influence on the markets that we tried to share in January. For your trading account, this didn't have anything to do with the slow money accounts. It had to do with the trading accounts that one would probably be wise to pull back in large cash positions, very big in your cash account, just to make a few small trades, keep the size of the trade small and keep the stops tight, as this is a fairly narrow trading range in SPY between 285 and 253. So we've been going on now over close to about 100 days, and it will end. But in the meantime, while it's in here chopping around, as last week we put two baseball players, or Lou Piniella arguing with an umpire. The umpire was saying it's a bear market, and another was saying it's a bull market. And I don't think in the short term that it's either. I just think it's a trading range. But from a long-term perspective, you can see we're still in a very solid uptrend, multi-year uptrend, and the action over the last 100 days has done nothing to break that. It's just a sideways chop taking place. In the Dow, a similar situation. We applied Fibonacci to the 2007 and 9 lows. The 26,700 level came into play as the 261%. As you can see at 1, it just tagged it to almost just to a T and stopped on a dime and did a reversal pattern. Now, this is a monthly pattern. You can see this is the February support, March and April. So we've had actually some bullish reversals take place at the bottom of the trading range around 23,360. So again, this is around a 10% range. It's fairly tight. We've seen some back and forth action, but again, this trend is still up. So for the slow money, we've not advocated any changes because there isn't any reason to. We'll look at later if long-term support, the advanced decline line break, the shoebox breaks down, junk breaks down. Those would be times where I think the slow money should make an adjustment. But at this time, everything's still the same. So this is a look at several key indices since the 261 extension levels were hit. The Russell's the tallest of the 7 dwarfs. In other words, it's lost 4.6% since the 261 levels were hit about 100 days ago. Nasdaq down 6%, mid-caps down 6.58, S&P down 8.15, and the New York Stock Exchange, or the broadest of the indices now, is bringing up the bottom down 8.68%. So this is why we tried to advocate. You can see it. I'm not a doctor. I can't read EKGs, but it kind of looks like one, just bouncing back and forth. A bunch of hot and cold activity with no really trend in mind, but you have seen obviously some declines in the key indices since the 261 levels were hit in January. So this was a chart that we looked at 2 webinars ago at the beginning of March. Shared, this is from good friend Ryan Dietrich, that March is typically a good month with gains to the upside. That didn't pan out. April's typically a good month to the upside. Those are the 2 strongest back-to-back months of historically the entire year, and we ended up the month of April essentially flat. The S&P was a little bit down on the year, but so far the seasonality perspective hasn't worked to the upside. And then now we're going to enter, the proverbial sell in May and go away. We'll see if that has any influence on the market. But so far, the positive seasonality hasn't paid off. Another good chart from Ryan. This looks at the best 6-month time periods ranked from best to worst. So if you look at the top, you can see this is where the winter months, actually winter going into spring. If you would invest the 1st of November and sell out theoretically at the end of April, that is your best performing 6-month window of an average gain of 7.1%, and it's up about 76% of the time. And so you can see the different 6 months windows. Again, this is a fall to springtime, winter into spring. They all rank it at the top. And then the worst is May through October, but you can still see it's has an average gain. So it's not something that's terrible, everyone, but it does get a lot of, and the average time that it's up is about 63%. So one of the things Ryan had put together I thought was interesting was the 6-month windows during and adding the presidential election cycle to it. So you can see that this is the second year of the presidential term, and you can see the May through October performance is typically the lowest of any of the May through October windows. You can see there's 4 different ones that he looked at in this time frame, and this is typically the lowest in the second year of a president's new term. So I'm going to ask, I'll have our first quiz, and so I'll give you a second to pull your box open if you can, please. Get the orange box, and for those that want to participate, to play. And so we'll bring up the question. So the question is what is the average gain in the month of May during the second year of a presidential cycle? Again, this isn't the 6-month window. This is just the average gain for the month of May during the second year of a presidential cycle. Excuse me. Okay, thank you for those that participated and excuse me, all choked up on that tough question. As a reminder, Rick will let you know at the after the webinar who won, and again, you can only win once per webinar. So this is from Dana Lyon of the Lion Share. I thought it was kind of interesting. It was something similar to Ryan, but this is the sell in May during the presidential cycle, something different. And Dana had calculated that if you go and look at the 4 years of the presidential cycle and look at the blue bars, actually in the month of May through October, or the time period, excuse me, they're all actually up except for the second year of the presidential cycle. So the answer would be 0. So Rick will calculate the closest to that, and then we'll award a winner again at the end. But as you can see, of any 6-month time period, they're all typically up, but this is the one that happens to be flat during the second year. So this would be the second year of President Trump's term. So we'll see. I bet that number won't happen. So, but here's a reminder, everyone, of this is from sentimenttrader.com. I thought this is a really good one just to kind of highlight why all of the buzz around the sell in May and go away. The sell in May is not really that bad, but what they did is they went back to 1950 and they looked at if you had invested $1,000, and you can see down here in the red, if you invested $1,000 on the first day of May and held it through the first day or the end of October, excuse me, that $1,000 became $2,000. So it wasn't a loss. It was actually a doubling of money, not really a very good compounded rate of return. And especially if you happen to add inflation to it, it was a negative number. But you can see on the flip side, if you invested money on November the 1st and did the opposite, the 6 months, and I guess nobody in the investment world has come up with something that rhymes very well, like the sell in May and go away. If you've heard of a good one during that time frame, let me know, from November to April. But anyway, a $1,000 investment became $79,000 in that 6-month window. So you can see why people highlight it a lot. This past year, the market did rally decently in the fall, and then once the 261 level was hit in January, it pretty much fizzled out and softened back. But I thought this was a good piece by them just to kind of show from a dollar perspective why the sell in May is talked about a lot, and really why the opposite, that the late winter, early spring months are typically pretty positive for the market. So the thing I think that is most indicative of really where the market is the advanced decline line. We try to share this very early on in all of our webinars and in our global trends report, because I believe this is extremely important to lift up the hood and just look how the average issue is doing. And as you can see from the 2009 lows, the advanced decline line remains in a very solid trend inside channel 1. It did hit it back in January. Ironically, it hit the top of the channel at the same time the Fibonacci number was being reached right up here. And then you can see mostly a chop sideways. But overall, I don't think this is a negative pattern for slow money, for money that is looking for really long-term moves. Obviously, this is a pause. This is potentially a pause for the cause of potentially higher prices. But the 80 line is actually closer to a new high than a new low. So to get a concerning message for trading accounts to be more aggressive on the downside, or slow money to pull back on exposure, one of the first things you want to see is the advanced decline line break support at 2, And as you can see, this has not happened. It came down, and the red support line is created off the January lows, excuse me, the February lows, and it is held. It's been touched one other time, but right now it's actually hitting the upper end. Could be a triple top, or it could be a breakout. So it'd be a very positive aspect to the longer term trend if the AD line would push to the higher side. So just kind of to zoom in on the AD line, instead of looking back over the last 17 years, just look back on the past 4 months. This is a look from December of last year to current on a daily basis. You can see that it peaked at the time that the 261 level was hit. It actually earlier this month came back and set on a daily basis a new all-time high, and then has backed off. So you do see a series of higher lows. So in the overall, you don't see negative divergences taking place in the market, and you do see it closer to new highs than lows. So this is why I tried to advocate, last week when the two guys were arguing this is a bull or a bear market. From a 30,000 foot view, the market's still in a bull market, but I want to try to empower you to gain some patience, just to kind of understand that this is just a sideways chop. When the 161 level was hit in 2014, the market chopped sideways for 20 months. It was, in hindsight, it built a very strong base to push higher off of. Once it broke out from that base, the markets rallied 50% in a little over a year's time. Humbly, I would be surprised if we build a base or trade sideways for that length of time. I just would be very, very surprised to see it. And if we see the AD line break to the upside here, I'd bet that this sideways channel would resolve itself to the upside. So again, the AD line is still acting healthy in and of itself. You would need to see a decline below the February lows and below the April lows to send a concerning message. Some of the bigger indices, just to kind of, to me, this is just a good snapshot of what's been taking place. The blue lines across the top are all the where the indices stood when the Dow and S&P hit the 261 level. The green horizontal levels are the February lows, which represent the bottom of the trading range. And then you can see for the most part that the S&P, the Dow, the NYSE, and the transports have created a series of lower highs inside this trading range. And then kind of coming in from the lower part of each chart, the red squiggly line is the 200-day moving average for each indice. And you can see that each indice remains above the long-term 200-day moving average, and the moving average is still has an upward slant to it, which is historically, bullish. So to send a concerning message to slower monies, in my opinion, you'd need to see weakness in the AD line and this low, this green shaded support zone of the trading range be taken out. And so far, that obviously has not happened. Just as a reminder, from a much longer term perspective, this is a global look. This is the S&P in the upper left, Dow in the middle in the top row, the Nasdaq 100 moved to the middle row. This is the Russell, mid caps, value line geometric, and then the lower level, this would be the DAX in Germany. This would be the FTSE, this is the CAC 40 from France, and then this is the FTSE 100 from London. So from a 30,000 foot view, all of these are still in upward bull trends. They are very close to the top of long-term rising channels, to where each of these have started doing the chop sideways, since the 261 levels were hit. But the 100 days of softness and chopping sideways in and of itself has not broken any long-term trends. We'd need to see more weakness to send a long-term bearish signals to these long-term bull trends that are in play. And you can see on a global basis, there's a lot of look-alike action taking place. Another thing that we want to watch close, it's been a favorite indicator of mine since the late 90s, is junk bonds. JNK itself has not been around since the late 90s. So in the global trends report, I always include PIMCO's high yield junk bond fund, which is symbol PHDAX. But as we just zoom in on JNK right now, the trend on JNK is diverging against stocks. You can see it peaked in 2014. It's in a longer term down channel. There's been a lot of news as far as a lot of liquidations taking place, in junk. The red shaded area reflects that there is a moderate downtrend over what the last 14 months, and essentially this pink area highlights since early 2017. And we do see a rising test of support taking place at 1. So for junk, it's not sending any outright bullish message to stocks, but on the flip side, it's not sending a highly concerning message to the bull case either. If it would break below the 2018 lows, which were the lows in earlier this year in February, and break the channel here at 1, that would be a time that junk by itself, it's not a holy grail indicator, but it would take further weakness to send a concerning message to the stock market. This was not obviously a technical chart or anything like that, but it really stuck out to me. It's something that this chart looks back almost to the time I started in the business. This is a look at in the green, the high yield default rate on junk bonds. And obviously if junk bonds are defaulting, that's a negative for the economy, oftentimes a negative for stocks. And then the yellowish copper mustard colored line is debt as the percentage of nominal GDP. And so it's kind of interesting to me that there's kind of a correlation to them. When debt got high in the early 90s, and you see a high yield default rate went up with it, and then they declined together. And then as they peaked, or they went up together into the 2000 time frame, and that's when stocks had some issues. They went back and forth, and humbly, I don't know what it means, folks. Obviously, the two pieces are that debt is rising and junk bonds are not defaulting. And so this is really a large fishmouth spread that something's got to give. I just thought it was really interesting to see a chart of this duration at this much of a dichotomy, really a hot and cold type of situation. So that kind of reminds me of some of the, this is a precursor, some of the things I'm going to show you coming up. There's a lot of yin and yang, taking place, but this is a big spread that something's, got to give here. One of the things that is far from proven, but from a pattern recognition, I want to just continue to update this. This is the Dow on the left on a daily basis, and the S&P. This is where each, the peak in prices by both are the 261 extension levels. And what you see taking place, last year when the trends were up, I bet 75% of the trades that we suggested were bullish ascending triangles. And a bullish ascending triangle is a series of rising bottoms and flat tops. And then when the flat tops are taken out, we would institute a buy signal. And we had some wonderful gains, high percentage outcomes. The pattern by itself suggests prices will result in breakouts to the upside 2/3 of the time. So this is its hot and cold cousin, is the descending triangle that's taking place. And the descending triangle is characterized by flat bottoms and lower highs. So it doesn't have quite as good of a track record as forecasting breakdowns as the ascending triangle has in forecasting breakouts. But this is still something that until proven differently, this pattern is in play. You can see the 200-day and the red line is moving forward. But I just want to let you know that why which I shared earlier, that if the February lows are taken out, then I think from a trading account, and if we saw further weakness in the advanced decline line, for those that are aggressive, they may look at shorting some. Other than a small little Nasdaq short, even despite these declines, we haven't seen evidence that it should highly pay off to be short. We haven't suggested it, and it wouldn't have paid off to do so. But if the February and early April, late March, early April lows are taken out, which is these blue support lines, then the measured move would suggest over a 10% decline in each index could take place. So this is still a possibility. Right now, with the advanced decline line acting well, I'd say this is a low probability. But I can't hide this pattern that continues to unfold as a possibility. So obviously the key support in the Dow is a little bit above 23,000 and a little bit above 2,500 in the S&P. And then what you do with this pattern is you take from the high to low in the descending triangle and apply it to the support line. So if the support for the Dow and S&P would be taken out, the measured move would suggest that the Dow at least reaches 20,500 and the S&P at least reaches 2325. So to prove this pattern correctly, obviously both have to take out their 200-day moving averages, and they'd have to take out the February-March lows, which has not taken place. On the flip side, what would it take to blow this pattern up? Because this probability, there's still at least a 35 to 40% chance that markets break to the upside. And it's just simple. If it breaks the falling resistance lines, it should attract some buyers. So I just still want to, even though I think this is a low odds circumstance, it would have some pretty decent impact on portfolios if both of these would decline, at least 1,000 basis points. One thing that I want to keep, attention on, Sir John Templeton, which was my mentor in the late 90s, just shared, hey, Chris, there's a few different reasons that I think buy and hold will struggle for at least 15 to 18 years to come. And one of those was the amount of money that people had borrowed to be long in stocks. In other words, the amount of money in margin debt. So this is from Advisor Perspectives and DougShort.com. And so what this does is the blue line is the S&P 500, and this goes back 20 years. And the red line is, again, this is an update, is margin debt, but inverted and turned upside down, just so you can see the spread that's taking place. And as I'm going to continue to reiterate month after month with these conditions like this, high margin debt by itself has not been bearish. It's when you've had high margin debt and then that margin debt starts to reduce, or in other words, when the inverted is low and it starts to curl higher, that's when typically your large fish mouth spread narrows. And at each one, you can see that when this started to narrow in 2000 and this started to narrow in 2007, you see that the stock market turned soft and the spread closed itself and actually flipped the other way around. So what does get my attention, this is not something that you can do market timing in my opinion on, but I would not want to be an ostrich and stick my head in the sand and say in time this won't matter, because in time it will matter. It's just I love that phrase, it doesn't matter until it matters. And so far this ever expanding spread has not mattered. So where it could matter is if the spread starts to narrow, or especially if you see margin debt turning up on an inverted basis, which would mean if we turn this chart upside down, would be margin debt would shrink. When people start pulling back on margin debt, that's typically when stocks go soft. And so this little bit, I don't think is enough to highlight, hey, the margin debt trend has changed. But if it would continue, and the spread starts to narrow, it could spell some frustrating times for the bullish case. So to me, the take of wanting to share this chart with you is just the massive spread that's taking place. And someday, I have no idea when this thing narrows, you want to be careful with the amount of exposure you have on the long side. Another perspective from the amount of money that's levered out there, this blue line, as you can see, is stock market leverage. It's net margin debt plus net leveraged ETFs plus net speculative futures positions from topdowncharts.com. So this was the 2000 peak right here. here was the 2007 peak, and here's where we are now. So you can see there's a lot of money out there on the long side. The trend is up, and I'd be the last person to say, hey, they're wrong with their margin debt. This isn't something that I do. I think, using 2x or 3x funds is a good way to take a bad decision and make it twice or three times as bad. And I haven't seen that in my 38 years that it was a great cause that you had to do that, because you can get really great places without levering up. And it's the levering. I remember Sir John talking about in the 1930s that some people lost their family farms off of $12 payments. And we all know that money was different then, but still a $12 payment on a debt loan that they couldn't service caused them to lose their entire farms in the 1930s. So debt can have its issues, and hope Dave Ramsey's proud of me for that. No Dave Ramsey commercial, but I'm just not a fan of people, you don't hear me suggesting trying to lever up during this. But again, just like the fishmouth spread on the prior page, this is a pretty expansive number on the debt that's outstanding. So just kind of for a second to talk about fear and greed. This chart was from a month ago. This is the CNN Fear Greed. You can see the date print down here in the lower right. This was April 3rd. This was from our last webinar. And you can see fear was actually quite high. This is an indicator of when investors are bearish or concerned, and this is when they're greedy. And that is actually, obviously, you want to think of contrarianism when you look at this. So I just wanted to share this. That was a month ago. Then you can see where we are now. You can see that the fear has backed off even during this choppiness. People have become a little bit more comfortable. You can see the indicators at 37. Right now, a week ago, it was at 33. You can see a month ago, it was at 8. It corresponds with what we saw a month ago. And a year ago, it was at 49 at a neutral reading. So we don't see any extremes in this range. Wanted to share this with you that this is probably shouldn't be too much of a surprise as we're in this chop going back and forth, that you see kind of a muted of emotions, that people aren't too excited nor too concerned either way. So I think this is a fitting, probably fairly accurate read of where we are right now. But people aren't quite as obviously the take on this. Fear is obviously not quite where it was 30 days ago. This is one that I talked about earlier. We're going to see a little bit of polar opposite opinions and takes, some hots and some colds. Well, this would be one that's hot, and it's the amount of hedgers or smart money that's invested in Dow and Nasdaq 100 futures. And this goes back almost 10 years, and you can see that this is from sentimenttrader.com and the CFTC, that at these dotted lines, when it was above this zero line, in other words, smart money was betting to the long side. This really stuck out to me, is that it was very intriguing that more often the market was a lot closer to a low and was set up to move higher when we saw that take place. And so you see quite a maybe, I guess this would be the largest net long position in the Dow and Nasdaq futures in the past 9 years, currently. So this will be really interesting. So we're seeing some monies start to take a fairly sizable long position that the trading range is going to result in a breakout to the upside. So just as a reminder from a 30,000 foot view, why I think we are in very important times. This is the Dow Jones monthly going back to the early part of last century. This chart probably starts around 1913 or so. But the takeaway for me here is that the majority of the last 70 years, the Dow's been in this bull market inside this rising channel. You can see it was touched. This is when I got into the business, when President Reagan came into office, and the Dow was below 1,000 after being at 1,000 here, touching the mid-range in the early 60s. You can see in the mid-range, it hit it in 1987, and once it broke, you had this strong rally in the 1990s. Then the Dow hit the top of the channel in 2000, or the late 1990s, and we know what happened to the Dow. Didn't quite reach it 2007. So the market's in quite a jam here between kissing the underside of a 70-year channel and this few-year rising support that's taking place. And you can see this is a monthly chart. This is this month right here. So this month is obviously was just part of one day, so I think it's insignificant. But you'll notice that the last 3 months, the lows have come in and very close to this rising support line. So there's very little wiggle room. Momentum remains overbought. And so this is the one place that I'll continue to say the same thing is bulls do not want to see support break here or the descending triangle to be accurate, because with margin depth where it is, momentum right now is back at levels only seen in 2007, 2000, 1987, and 1929. Those are some of the key dates that this is where momentum is really high. So the trend is up. Nothing has changed of late. And obviously, if the Dow would break out to the upside, it'd be super bullish, folks, despite that momentum. So real tight jam, not to, for me to be a surprise to see this choppy action taking place. So as a reminder, we'll just quickly go through it. A hanging man pattern looks like this. And if you watched any of the prior couple of months Connect series, we've discussed, because in February, a lot of potential hanging man patterns took place. But as a reminder, the hanging man pattern took place in 2007, or excuse me, in 2007 it looked like that. And this is a reminder of what it looked like in the month of February, in 2018. And so we're watching this pattern. The markets have obviously been a little soft since then. But when the hangman pattern took place in 2007, it didn't take too long for the market to get soft. But just because these take place does not mean the market has to tail off right away. Here's a reminder of the pattern last month, or from last month's webinar, There's the hanging man. And it also, another one took place in 2000. So this pattern is not proven that it's significant, but it'll never be taken off the charts. It's one that I'm not going to forget, but it doesn't mean that it's going to break the long-term trend channel. If we would see further weakness take place, then the technicians would go back and say, aha, that pattern in February was very important. So I will continue to bring it up. I don't mind having omelets on my face as far as that it's a waste of your time to discuss this, because if these patterns would be significant for the long term, they would be highly significant. As a reminder, the bank index created a hangman in 2007. It created another one in 2018 at the 2007 highs. You can see the size of this was very large. So we're going to continue to update. So this is an update current through today of the hangman pattern in banks at the 2007 high, took place at 1. You can see this past month that there was a small bit of softness in the banks. But if you would make a plus sign in your mind or write down a plus sign on a piece of paper, a doji star is a market pattern that looks very much like this. And doji stars, you'll see me discussing it for a while, can be significant at the key market turning points of highs and lows. You can see a doji star took place right here in 2015 before a significant decline. Close to a doji star here, close to a doji star right here at the 2006-07 high in banks. So this in and of itself is not bearish. Could be a reversal at support that it heads higher. So, but the bottom line is a doji star is representative on a net basis of a month that didn't go anywhere. It just had some up and down movement with a net very little gain. So it is continued banks to test support. The broad market would not want to see banks get weak here, because it's very important for banks to keep moving higher to support the broad market in general. This was a chart shared back in February of the Nasdaq composite, that it was at the top of three different rising channels. One, this rising channel dates back to 15 years. That's been taking place since the early 2000s. Channel 2 has been taking place since 2010, and Channel 3 has been taking place the last couple of years. And right in here was that monthly hangman that took place right at triple resistance. It tried to break out, didn't have much success. So again, this is a chart from essentially the 1st of March, about 60 days ago. So here's an update on last month when we shared this chart, that it really caught my attention that the high in 2000 took place on March the 10th. The low in 2009 took place on March the 6th. And so far this year, the high took place on March the 9th of 2018. So here's an update. This is this month's chart. This is a reminder of the March turn dates. This is a reminder of the blue shade of the 15-year rising channel. And you can see what has taken place in the Nasdaq. It's definitely still above support. There's potential that the Nasdaq has created a topping pattern. But again, for the long-term trend, for sure is still up. And for this to be a topping pattern of a head and shoulders variety, it needs to take out the neckline to prove the possibility that this is here. If the neckline would be taken out from leadership, obviously, it'd probably be rough on the broad market. But for the most part, still choppy action and a series of lower highs over the last couple of months. As a reminder, the Dow Transports also created hangman patterns in 2011 at one and 2014 at this other one. Both declined almost 30% following those patterns. It created another hangman pattern in February. So this is an update of the transports. And look at this, everyone. Almost a couple of doji stars the last couple of months. So this was February. There's March. There's April. And that's just one day, obviously, the 1st of May. But 2 months of open and closes almost at the same area. So again, this doesn't surprise me. And this is why I've tried to encourage to all of you over and over and over to in your trading accounts, just sit back and let this rocking chair, go nowhere action, this gerbil in a cage, just keeping people busy spinning. Just sit back, and it's going to resolve itself. And the longer it does this type of action, the better it will be, because the breakout or the breakdown will be even bigger. So if you had your fingers crossed, despite it being boring for a while, is you should look in the mirror and say, I'd like to see this go on for a while. I'd like to see it to go on for quite a while, because then when it finally does, it's a really significant move at hand. So time for another quiz. So if you can expand your boxes. Anybody got any guesses with this dogs here, what the question might be? So the question for the next $50 Amazon gift card is, how many of the Dow 30 stocks are lower over the past 12 months? Again, in the Dow, there's 30 stocks. How many would you guess is lower over the last 12 months? And I should have asked maybe what is the number one worst dog in the Dow over the last 12 months. But here's the answer. 10 of the 30 are lower over the last 12 months. The green shaded area shows the dogs of the Dow. Or excuse me, let me take that back. Rick will need to adjust the answer. Only 7 of the 30 are lower. So that would be our correct answer. You see with the negative numbers. Let's see. 1, 2, 3, 4, 5, 6, 7. There would be 7. Include General Electric, which is the worst, down, lost half its value. Procter & Gamble, Disney, IBM, Merck, ExxonMobil, and 3M, and that's through April the 30th. So thanks for your participation. And again, Rick will get back with the winners after the webinar is over, and you can only win one time. So still, to me, one of the weaker indexes this past month was semiconductors, and to me, this remains a highly important chart. This is SMH on a monthly basis, and it did create a couple of months ago. This is the month of February. You see this long hangman pattern, and then you see a reversal of that where it tried to break out on a monthly basis 2 months ago in the month of March. And so that's the largest reversal pattern, bearish reversal pattern, since right here in 2000. So that took place at the 2000 highs, and momentum is very lofty. So that's on a chart, that's a very negative pattern that's taken place. I believe semiconductors were down around 5% or 500 basis points last month, but that decline did not break this lows. The next chart we'll look at it much closer. But again, this index off the 2009 lows gained 100% more, or gained twice as much as the S&P 500 off the lows. So to me, this is an important leadership stock, what it does up here. We'll see here in this chart. Here's a much closer look on a weekly basis. You can see that support is in play. And even today, when the Dow was down a couple of 200-300 points, semiconductors were actually hanging in there because they're hanging in on support. This could be a head and shoulders topping pattern. You can see it's broke below channel 1, this rising channel, the last few weeks. But now it's testing the 2017 and early 18 and the lows of this past week currently. So I really believe, obviously this is a support test. It's we could call it a 6-month support test taking place. Looks to be the neckline, which necklines are supportive until broken. So this would be, to me, one of the more important stock indice patterns to, if you can on your quote system, even if you don't own it, I'd encourage you to have the symbol SMH up there all the time to watch how that's doing. Because if we see this continue to head south, I'd be very surprised if the Nasdaq could do well, and if the Nasdaq would turn weak. I'd be surprised to see the broad market move higher. But right now, you know, with this support being in place, this would be a great time from tech to the broad market to rally if this can hold. So this is, to me, one of the biggest tests, because as we looked at all the other indices earlier in the webinar, none of them are close, hardly any of them are close to the February lows. And this is back at the February lows and also the lows of last fall. So this is a big test by leadership. And so just a reminder, with Wile E. Coyote, he kept trying to destroy the Roadrunner, and he kept, you know, getting blown up. You know, what could blow up those monthly hangman patterns? And it's just a reminder, it'd be nothing more than just these markets to rise and break out of these long-term trend channels. So even though those hangman patterns are there, and I don't believe we should, like I said earlier, be an ostrich and stick our head in the sand and overlook them, the long-term trends on indices around the world are still up despite choppiness over the last 100 days. So it's just a reminder that until the 261 extension levels are taken out to the upside in your trading accounts, I'd be very conscious on capital preservation, keeping high cash levels, trade infrequently while in this tight range, trade small, keep stocks tight. I wouldn't encourage broad-based shorting at all. We have not done it. I haven't encouraged it. But if we would see, as I shared earlier, the February lows taken out, if the advanced decline line would take out the February lows, if junk bonds would turn weak, that would be what it would take to encourage or say that you have a higher probability of shorting, which right now is not advised, and it's not been profitable if somebody's been trying it. So moving on now out of the stock indices, tied into the commodities world and some of the currencies. This is one that could impact a lot of different currency plays. So this is the euro over the last 30 years. And you can see right here in the late 90s that the euro came and kissed the underside of this narrowing pennant pattern. And once after it and came back and tried to get above dual resistance, it really started tanking hard. And typically, when the euro happens to fall, commodities struggle. And so this is a very important price action to me, that it's kissed the underside of a very similar looking pattern at almost the same level. If you look at this, everyone, as in the late 90s, almost the same level at 2, and then you see it peeling down and breaking support at 3. So I want to empower you to see what's taking place in the euro, because this is important to commodities. And then you can see almost on the flip side that this chart, if you're historically bullish commodities, obviously not all commodities zig and zag exactly with the US dollar and the euro, but overall they are influenced, I believe, by some of the commodity or the currency trends. You can see we've been sharing this for quite a while, that it appears that a cluster support test was in play for the dollar after it peaked in late 16, early 17. That's been falling for almost a year. Came down the test quad, or almost 5 support lines, built a little base. This is typically a bullish falling wedge that 2/3 of the time leads to higher prices. So I think this strength here in the dollar, and on the prior page, the strength in the euro after that kiss took place, is why we see metals have struggled, for a while. So these to me are important for metals members and obviously commodity plays. And so speaking of commodities, as a reminder, this is the Thomson Reuters Equal Weighted Commodity Index going back into the 1960s on a monthly basis. And oftentimes it seems to work on a 16-year cycle. We've shared this a couple of times, and this chart will be updated on the next slide. But as a reminder, rising support is in play as this potential 16-year cycle is coming to an end, and also 7-year resistance test falling channel is in play for commodities. And if they would break out at 1, despite what we just saw on the prior currency charts, if commodities would break out here at 1, it would be something positive that commodities haven't seen, obviously, for almost 8 years. So here's an update on that chart, that it's spent the majority of the last 30 years inside rising channel 1, the majority of the last 7 years inside falling channel 2. Applied Fibonacci to when it hit the top of the channel here, and the bottom of the channel here, and this is the 23% retracement level of that multi-year decline. And you can see it just keeps banging its head. So this is obviously in a really tight jam. This is an opportunity for bulls and bears both. Obviously, if resistance would hold and commodities would turn down, this would be an ideal place to be looking at shorting commodities, because it would be breaking a couple of long decade support channel. But on the flip side, if it can, after all these years of heading lower, if commodities could break out here at 3, that'd be something that it hasn't paid to be buy and hold, get your favorite drink, own commodities, and just sit back and soak it up. That just hasn't been something that could be done. But if they would break out at 3, this could be a time that we could actually buy and hold some commodities for something more than just a few week trade. So this is really intriguing to me, that I'll definitely be looking at intermediate to very long-term trades if commodities could break out at 3. So a huge test. I think the most important commodity, in my opinion, in the world is crude oil, because even for some countries, they use it as a currency for buy and sell goods. This is again a 30-year chart on crude. You can see these blue channel lines that I've drawn in took into play from the 90 high, the 99 high, and then you can see tried to break above it in the early 2000s, and once it did, this is what, 50, 40, around what the $45 range. Once it broke out here, everyone, it was off to the races to almost above 150. So I just did a copy parallel of this long-term trend line. You can see two large bullish reversal patterns here, monster bullish reversals. So I copy pasted and it just applied to these highs, applied it to these lows. So now crude oil is testing the 50% level from the 2010 high to the 2015-16 low. It's at its 50% retracement level. It's butting up against this channel line at the apex of a historically bearish rising wedge. So this is a really, right now it's an 800-pound gorilla for crude oil. But in the overall commodity picture, if crude oil can take out this 50% level, it's probably got some freedom to run, clear up to roughly what, the $90 range to 95. So this is really a big test. It hasn't proven that it can, but I just want to say that if it could break out here, it's now back into this trading range that in the long, not that it would reach 95 right away, but it'd give it some freedom to get back into this range. So this is a huge test for crude oil and commodities in general. So a lot of talk has been about inflation and different things. This is an update of the TIP, which is the inflation sensitive ETF against the TLT, creating the ratio of the TIP TLT. And so when this ratio is moving higher, it's historically rough on bonds and can send an inflationary message. So you can see the longer term trend is down in the pink. But the rally over the last few years has the ratio testing triple support up here at 2. So this is another piece that I'm watching closely, which can be a very good signal for all of us folks on how much commodity exposure that we might want to have in our overall portfolio. Because if it would break out above this falling channel and break above, the 2015 and 17 highs, that'd be rather bullish for the inflationary picture, which should give a little bit of empowerment and confidence to commodities if that took place. So far, the 2015 and 2017, they're just resistance sitting up there. But I want to empower you and let you know how important that resistance level is, because if it's taken out, you can probably want to have a little more exposure to commodities than what you've had for almost a decade. Another good symbol to watch for on whether inflation's back or lack thereof is old Doc Copper. You can see copper has been in the blue falling channel for 8 years. It hit the bottom of the channel in 2015, similar to what the TIP TLT ratio did in the prior chart. And then we see this counter trend rally. It's rallied up, and so here's a heavy resistance, a potential topping pattern. But again, to prove that this is a topping pattern, the neckline has to be taken out, which has not taken place. You do see momentum is as high as it's been since the 2011 peak in copper and commodities, and it's rolling over. So again, this is another good indicator to watch to help make commodity decisions and commodity exposure decisions, because there's obviously two parts. Do we want to own some commodities, and then how much of our overall portfolio do we want to expose to that? So again, the TIP TLT ratio and Doc Copper are ones really important to watch. So this is an interesting one from a commodity perspective, and also kind of a buy the rumor, sell the fact. This is U.S. Steel. And for those that have been members, we've traded U.S. Steel, and we've had some luck with it. But you'll notice that the rally going into the year, steel and tariffs obviously have went almost hand in hand over the last several months. But you'll notice that U.S. Steel, its rally happened to come right up and peg the 2014 and 2011 highs. You can see 3 bearish reversal patterns there. There's a chance this is a head and shoulders top. And I apologize, I don't know where U.S. Steel finished on the day, but over just the last couple of weeks, it's down almost 25% and is attempting to break dual support at 2. So this would be one that would put a little fly in the ointment potentially of the commodities picture, that you would really think that if commodities are going to do well, that you'd see U.S. Steel acting better than this. So a really big support test in play for U.S. Steel. And a similar case for Freeport-McMoRan, FCX. You can see that it rallied, bottom, in 2016, similar to many commodities, ran up against resistance in a sideways trading range. And to me, everyone, the prior 2 charts are a great example of when trading ranges end, how much volatility can pick up. And so chop, 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 go nowhere for several months in a fairly narrow range from essentially $17 to $20. That's what, around a 15% range. And then once support broke, bam, it takes the train and heads south. And so FCX is down nearly 25% in the past couple of weeks, breaking support. So this is another one that would throw a little bit of a yellow caution flag to the commodities trade. So moving quickly on to another commodities play, but in the metals market, is the silver gold ratio over this looks at silver futures divided by gold futures over the last couple of decades. Again, to be long and strong silver and gold, you want to see the ratio heading up. It's obviously extremely oversold. It's done poorly since 2011. It's testing line 1 now for the 4th time in 15 years. This is a monthly chart, and I want to point out that we've talked about bearish monthly hangman patterns. Well, I want to introduce you to possibly a bullish monthly hangman pattern that took place possibly last month right here. So it's the polar opposite. It starts out at a certain level, tries to rally, and then comes back and closes the month there with a very small body. But that took place right on support. So there's nothing proven. But from a technical perspective, it's kind of a cool thing to see if you're open-minded to higher gold and silver prices. So nothing is proven, but that's a really interesting monthly pattern to take place in this key ratio at a quad test of support. That each time, one of our prior quizzes was what was the average rally at each of these one price points when the ratio took off, and somebody answered correctly a couple 100%. So real big test taking place. Obviously, if support would be taken out here in this ratio, the trend would be to still stay away from the metals aspect. So trend is down, key test of support with possibly a bullish monthly hangman pattern taking place last month. This is our 6-pack in the metals complex. Gold in the upper left, in the middle up here is GDX, upper right is GDXJ. This is the GDXJ GDX ratio. This is the gold US dollar ratio, and this is SLV GLD ratio. So for the most part, you can see moving back to the top, gold has been soft in a trading range. As of today, it's testing the bottom and potentially trying to break down here. GDX here and GDXJ, sideways action. The ratio is, apologize for that. The ratio is soft, which is not bullish for the index in general, or for miners in general. You want to see this breakout to the upside to be bullish. I think the one that sticks out the most to me is that if you're wanting to be bullish the metals complex, you don't like seeing the gold dollar ratio breaking down. That's obviously a concern here. This is SLV GLD, continues to head south. This is one that's continued to suggest stay away from metals on a buy and hold basis. It's been accurate as far as its prediction of just stay away because the gains haven't been there. but it is near the 2016 support test. DBC commodities, as we looked at earlier, was a Thomson Reuters was testing the 23% Fibonacci retracement level. DBC is also testing the 2015 highs as we speak here. Potentially, this is a weekly chart. Don't want to see reversal wicks taking place. But if you're not long commodities and you want to wait on this, if DBC would take out essentially this blue 1781 level, that would send a quality message for DBC, because then if it could rally a little bit more, it had room to run up almost to the $21 range. So a big test of resistance for DBC on a monthly basis taking place. Turning to the bond market and interest rates, this is we'll continue to update either a 2 or a 4 pack on this, but in the upper left is 2-year yields, upper right is 5-year yields, lower left is 10-year yields, and lower right is 30-year yields with momentum applied to each. And so as you can see, long-term trends remain down. Long-term channel resistance is being tested by each as momentum is very lofty. So as many want to say, the bond bull market, the 30-year bull market is over. I think it's a little premature to say that. Obviously, the 25-year channel test is in play, but right now interest rates on the long-term end of the 10 and 30 are still below where they were, 4 or 5 years ago. So if they take out 2013, 14 levels, I could see rates, rallying up, a good bit. So big test from short to long on the yield basis of long-term resistance channels by each one of these, as momentum is crazy high right now. So again, as we wrap up, as Bill Gates says, I'm going to continue to remind this, while we're in this trading range, patience is a key element of success. It's very common to get little nicks to take place in trading ideas in narrow ranges. That's why I say with the probability of nicks being high, you just don't want to take too many of them. And so I'm trying to stay very light on any ideas. I'm going to take little pot shots here and there, but not back up the truck, by any stretch. As a reminder, I'll send this out in a separate email. This is the May seasonal strong stocks. You can see on average, the average return over the last 10 years in the S&P is 14 basis points with the median return 1.46. But there have been a few stocks that have done well over that time period. But one thing that jumped out at me this year, I've tried to share the sector that each of these stocks are in. And the blue shaded, what stuck out to me was we've got 20 stocks, and 1, 2, 3, 4, 5, 6, 7, 8. 8 of the 20, so about 40% of the stocks are from one sector, which is healthcare. So I'm going to show a couple of charts here as we finish up, the webinar. But these are the 8 charts and what they look like. These 8 shaded in blue. You can see that REGN has a median return of 11.98. It's been up 10 out of 10 years. And so I just did some really quick preliminary power of the pattern analysis on these stocks, and here's a snapshot of these. So overall, it shows that the month of May has been pretty good over the last 10 years for healthcare in general. You can see most of these trends are actually down, with the strongest being Humana in the upper right. But I do have, I set alerts at each of these blue horizontal lines that if breakouts were to take place, that it'd let me know, and then I'll reach out and let you know if these happen to break out to the upside. So just kind of wanted to share with you that there was somewhat of a concentration of success in the month of April in healthcare, these 8 stocks, and then what their patterns look like. So wrapping the webinar up, I want to thank you for your business. Thank you for being patient in this trading range. look at it. You can look at the donut as the donut or the whole. I look at the donut that this is going to really lead to some really great opportunities, and that's why it's worth just being patient through this, and it'll lead to the longer, as I said earlier. One of our prayers ought to be is that the sideways chop continues for a while, because then when it finally breaks out, it'll be even all the more significant. So wishing all of you the very best, and we'll see you, hard to believe, the 1st of June. Take care, everyone. Thank you.